Do we buy now or wait? This is a common question that we're asked every single day here at Black and White Finance. To uncover this, we look at what has happened in the last 12 months and the growth that there's been in the property market. The next question, which is, well, okay, if you get in, what if the market crashes? What are the consequences? What are the risks around that typical question? Then we also get into how to then get in. So if you understand what's happened historically, then you understand the risks around the property crashing. How do you actually get in? I'm Peter Vasilis. Welcome back to the Black and White Finance video series. Today, I have the pleasure of being joined by two of our best, our mortgage brokers, John Lee and Michael Archdall. Welcome, boys.
Thanks, Pete. Nice to be here.
Thanks for the pump up, Pete. Thank you.
Let's look at what's actually happened over the last 12 months, maybe even 24 months. What's actually cost people by not being in the market, by not getting in. Brisbane, Perth, Adelaide. The data there, even Cotality's most recent data for the last 12 months has shown some significant increases. Basically missed out on 20, 24, 26% growth in the last 18 months, which is quite crazy. If you compare that on, call it a $500,000 property, that's a significant increase. If you're paying rent in Sydney, right at, call it $750 a week, that's $39,000. That's not going towards paying down the principal on your mortgage, so building your equity. It's going to the landlord's back pocket. And at the same time, you're missing out on the equity gains, on the increases there. And we look at that and we say, okay, well, all right, great. We understand that there's some serious risks there. But tell me, like from your end, like how do you see it? Like, have you had experiences where people have actually gotten in last 12, 24 months and made some serious gains?
We've definitely seen a number of clients who did buy 12, 18 months ago. Some of them even taking out higher loans where they're paying mortgage insurance initially, paying a higher rate initially just to get into the market. It comes to their 12-month review mark. The property's increased enough in value, / they've also paid a little bit down of their principal, that the property is now at a sub 80% loan to value ratio. And that means we can then contact the bank and renegotiate a much lower rate. It's only taken 12 months to get there.
So this is pre 1st of October, new government guarantee schemes, which we'll touch on later. So they've come in, bought it at 90% and paid a higher rate, got them into the market, but now have had equity increase for them. They've paid down a little bit of the principal and we've now gone back, renegotiated with the bank because the equity then got another better rate. That's an amazing result. And now I'm sure they're probably considering, do we go again? Is there a, yeah.
People always have questions, well, when can I go again, right? It's a matter of planning and what your actual risk appetite is at that point in time as well.
What about you, John?
I suppose touching base with places like WA, like actual case studies, 2 separate clients, one first home buyer, couple rent vesting, bought in WA. They literally saw an increase of 30% in the first year, were able to access equity, then to buy another property. They were using a buyer's agent to help them with this, but we're actually seeing these values go up, not just on data, but we're actually seeing real life cases. Similar situation with another client that bought in Waikiki in WA, highly leveraged, similar to Michael's scenario, but they've also seen instant gains and they're able to access equity again to buy second and third properties. I suppose utopia for them in that rent vesting scenario, but we're actually seeing those come into fruition and it's pretty cool to be in that space where we're able to have a plan and to execute it and be involved in that whole process.
Cool, so yeah, we can see there historically what has actually happened, right? So we know that there've been instances there, the growth and the data has actually been, we've got this empirical research here ourselves of not just data, but touching and feeling it and tangible experiences. But what about that? What if I do get in now and the property market crashes? What if the property market busts? We've heard this a lot, right? To understand historically what's happened with property, right? So let's understand the data behind this risk, right? Let's understand the risk. The last, let's call it 50 years, right? Let's go back. You've had tariff, you've had pandemics, you've had GFC, you've had the 70s, you had oil crisis, savings and loans crisis. Keep going, right, through this. You always see a little blimp, right? Little blimps, but it always comes back. Even in the GFC, 10 to 13%, depending on which data you look at, is what the market did dip by, but then it came back. Look at the pandemic in COVID, it dropped a little, and it came back again. you need to understand this history here to understand, okay, well, what can potentially happen in the future based on what's happened before. That's an important aspect to understand. I think we then should explore the supply and demand economics 101 and understand exactly what's happening at the moment. The most recent data.
They're saying that basically we're short by 1.9 million homes right now. That's the only way that we can make housing more affordable in this country is if 1.9 million homes all of a sudden were built.
So this is according to HIA, right?
Correct.
And they were saying that there was a 200,000 shortage before. Now they're saying we need 1.9 million now to help the Australian on the average income be able to get into the market. That is a massive shortfall. It makes sense that there's just not enough property there to keep up with demand. And then let's look at, suppose, that population growth. It's been pretty significant for a long time. Yes, the last year in 2025, it's slowed down, but there's still growth there. The foreign stamp duty now, especially for like in New South Wales, that stamp duty is now making it harder because it's pretty much double. But it's only slowing down the foreign demand, as we've all seen. Why does everyone want to buy here in Australia? Like, why does, I suppose, the world want to buy here? We're considered a safe haven. We've got lovely beaches, lovely outback.
Best coffee in the world.
Best coffee in the world. There's, I suppose, many reasons for people to want to live here, right? So understanding historically what's happened, understanding the shortage, especially according to the HIA data, understanding the population growth, understanding that we are a pretty cool place to live in. All those factors combined, I suppose, make that what if the property market crashes risk somewhat easier to understand, right? Is there anything else you think we should add to that?
I suppose it's the Australian dream. It's to have home ownership, right? From a young age, it's something that's sort of taught to us of you own a home, you pay off your mortgage, right? And as long as we have those fundamentals being passed on, I think the prices will continue to go up. And I don't think the bubble will pop. Maybe it will slow down at some points, but you know, they always say past performance is an indication of future performance. But when you got data of 50 to 100 years, I think it's a pretty safe bet.
I agree. I do agree. Not just because I'm a mortgage broker, but I do agree because of this information here.
People don't want to be renting full-time where they might get kicked out because the landlord decides to sell or their family member needs the place or whatever the reason is. That's what drives a lot of people, I think, into the market, and that's not going to change. People are still going to want that security. They want that security for their family, for their children to go to school, to grow up. And that goes back to the Australian dream, right?
I think now we should jump into that next question. So, okay, well, how do I get in? What do I need to do to get in? We've put in place for people 3, 6, 12-month plans. We'll jump to you, Michael. Let's talk more about, I suppose, that initial step, the savings, cut back on some of those discretionary items.
Well, I guess when it comes to getting the savings to actually get into the market, that's obviously one of the biggest issues that most people face. There's so many different ways though that you can go about it. Yes, there's the traditional way of not going out and buying your smashed avocado at the cafe every weekend. If that's going to help you save for a deposit faster than in the next few years, sure. But there's other ways as well. There's now all the schemes, which we'll touch base on soon. There's family members, people are getting gifts left, right and center.
Bank of mum and dad.
The bank of mum and dad is huge. That's what's helping a lot of first home buyers. I guess not everyone is lucky enough to have the bank of mum and dad there. And so then you start looking at these other options. But the whole idea is you need to understand what's actually available to you. And to understand that, you probably need to speak to a mortgage broker in the first place.
You just touched on it now. So the schemes. So that whole 20% myth or that 20%, you know, it's the preconceived idea that I need to have 20% to get into the market. That doesn't exist. And special thanks to the federal government with this new home guarantee scheme before 1st of October. So there was limited spots, there was lower price caps, and there was income thresholds. Post 1st of October 2025, the federal government's gone higher property price caps, no income threshold, And they've also then said, okay, well, let's get rid of the spots, let's make it unlimited.
Pretty much allowing all first home buyers into the market, and the most limiting being the price cap. So someone like Sydney, it's gone up from 900,000 to 1.5 mil. But there are other factors to play, such as transactional costs like stamp duty, so on and so forth, which we could touch base on a little bit later. That myth of that 20% deposit, yes, it's utopia. Amazing to have. You have a smaller loan, but for you to save that 20% at the current pace of the market growing, you wouldn't be able to save fast enough, essentially, unless you had a big inheritance or a gift or a huge pay rise. It's been nice, I suppose, for first home buyers to have access to this, but obviously the large concern is, what does it do to property prices? More competition, more demand,
Higher prices.
higher prices.
With those lenders, the participating lenders, they're busy. We've seen their service levels blow out, especially in the last couple of weeks. So let's see how long it takes for them to come in line with, I suppose, the previous service levels that they had. When you do have that 5%, you don't need to have the 20% deposit. The government guarantees the mortgage insurance for you, so you don't pay the mortgage insurance. And on top of it, the bank gives you the same rate as if you had a 20% deposit.
Most of the time.
Most of the time, most of the time, most
As
of
we've
the time.
seen, banks have become a little bit creative to ensure that they have their clip. But yes, it's very competitive rates, and you avoid a hefty 10, 20 grand or 30 grand of mortgage insurance.
In New South Wales, if you purchase anything under 800,000, you don't pay stamp duty. I think it's about 30K.
About 4%, yeah.
That you're saving straight up off the bat. Once you get above 800,000, it's then prorated. 850, I think, is about $10,000, 900, 20 grand in stamp duty, 950, 30 grand. And then by the time you get to that $1 million mark, it stops. You're paying full stamp duty, you're paying about 40 grand. There is a huge benefit if you can get close to that 800,000 or under, that you can get into the market with 5%, minimal transaction costs, and therefore you don't have to have that massive savings. Obviously, getting into the market under 800,000, depending on what you want to buy, where you want to buy, especially in Sydney, is going to be the tough ask. There is property, it just depends on if it matches with what you want.
To tell you the old CoreLogic, they put together these graphs where those areas in Sydney, where all units predominantly, and then houses where you're under the home guarantee scheme, and then those that are outside it. But yeah, predominantly units you're seeing that are still under that range. But yeah, we're seeing more so participants not eligible for the stamp duty full waiver, but they do get a discount when they're scraping in under the mil. But it's predominantly the federal guarantee scheme that we're seeing, because the property price points between 1 and 1.5.
And I guess every other state has their own policies and different rules and that in place as well. Like I know, and some of them are to try and boost housing supply. So like you look at Queensland, and if you're looking to build a brand new property, you can go under the scheme, build that property under the scheme, only have the 5% deposit, and your stamp duty is fully waived. It doesn't matter what the property price is. Obviously, for the federal government scheme, it's got to be under that $1 million mark of Queensland if you're looking around Southeast Queensland, Brisbane, Gold Coast, Sunshine Coast, which may be your problem. But I guess it depends on where you're looking again in that area.
Yeah, and that's the thing, right? You're seeing under those property price caps that are under the home guarantee scheme, we're seeing those price points push closer to those caps, right? And only naturally, based on economics 101, like we spoke about before, when there's not enough property there to meet this demand, we're seeing it push closer to it. So yeah, it's a very interesting landscape for us. But yeah, hopefully it doesn't blow the doors off the market. Just to recap, we understand what's happened historically, and I suppose the risks and those challenges and the affordability comparisons that I suppose renters need to make between waiting, sitting on the sidelines versus getting into the market. We understand then the risks around the notion of the property market crashing. We understand then, I suppose, how to get into the market and what potential schemes are available. So let's just say we now are comfortable with this life decision, this milestone, and we want to get in. What's the next steps? What's this method to people's success here? What's a journey for people to follow?
So first thing is to speak to a mortgage broker is to get an assessment of your circumstance, your financial circumstance, to go, are you ready to go onto your property journey now? Is this something that we look at 3 months, 6 months, or 12 months, right? For us to get that, we need to have a conversation, get a understanding of where you sit. And if you feel like you want to go through the process, we'll get documents from you to fully assess and provide a preliminary assessment of your file. We'll then have a meeting with you to discuss our recommendations of the 3 best lenders. And from that point, we can then proceed with the pre-approval if the strategy and the timing is right. We'll hold your hand through the entire process. And once we get pre-approved, we'll be then looking for properties.
So it doesn't matter really what type of property they're buying or what type of investment that they're trying to get into here. The same steps do follow, but for a first home buyer, understanding those options initially, making sure that that strategy is in their best interest, they're making sure that those lending options are in their best interest, making sure they're comfortable with that is what I suppose a first home buyer even needs to understand, or even someone trying to buy an investment property needs to understand. Once they know the lending option, the strategy, and the time is right, how does it then happen? Well, what's the process from then on, once they've been given this, call it a proposal as such?
Once the proposals are given to you and you consent and we're ready to essentially start looking at the market and actively looking, right, we will be lodging an application with the bank for a pre-approval. This really is simply the bank substantiating our findings and our own assessments, right? So we'll have a very high degree of confidence that your application will be approved.
And you want to be with someone or a brokerage that has a very strong conversion rate, right? Close to 100% there, and that's a definite plug there.
Exactly, and and one of the things that we're finding with banks dealing with service levels is sometimes these pre-approvals are not worth the paper it's written on. They're system generated, so no one's actually looking at the information that's being plugged in. So I think it's once again very important to speak to someone, and mortgage broker will fully assess your file in-house. So when it does go into a pre-approval, they'll make it really clear whether it's system generated or whether it's a fully validated pre-approval.
And then if you're eligible home guarantee scheme participant, what happens at that stage then?
So we'll hold your hand to the entire process, get all the forms ready. So essentially when we lodge these forms to the bank will essentially on your behalf get a spot on the scheme for you.
Reserve a scheme, yeah.
And the good thing now is there is no limited spots, so it's unlimited. So as long as you're eligible, you will get a spot. So that's pretty cool. There's no what ifs, what if I don't get a spot, because that might make or break a deal.
So let's just say now we're lodged, our application is in the system, and then what happens?
Well, hopefully you get pre-approved. I mean, if you don't get pre-approved, obviously you've got a bit of a problem on your hands. But
and again, you need to be with a partner brokerage or then that's got a good strike record then. Yeah. So conversion rate's very important.
it is. And I guess making sure you're with a broker who knows where to put you based on your circumstances, because it's not every bank will accept every circumstance. But once you're pre-approved, obviously the fun part begins. Now you get to go out and actually start looking at properties seriously. You know what your budget is, you know what you can make, what you can offer. And so now you've got to actually go out there and start looking and seeing what you like, what you don't like, what is actually in your range, not what the real estate agent tells you is in your range, what property is actually selling for.
Can you just explain to us a bit more about, I suppose, the old RP data report, and which is now called the Totality Property Profile Report? Explain to us how important the data is in these and understanding the data.
These reports ideally give you properties that are similar to what you're looking at and tell you what they've sold for and when they've sold. That allows you to understand, well, how does this compare? Did that property have its kitchen renovated? Is the property that I'm looking at have its kitchen renovated?
In terms of comparables, yeah.
How much is a kitchen renovation possibly worth? How big is the property?
So square meters.
Square meters. If you're looking at houses, obviously you're looking at land size. If you're looking at an apartment, you're just looking at the actual internal square meters of the apartment. These are all factors that come into play. The report goes deeper. You can look at school zones. School zones can often have quite an impact on property values. If there's schools that people want their children to go to. People are willing to pay more for property in those areas. It gives you rental estimates. There's so much information out there.
So let's just say then you've had this data, you've had these reports, you've had us or any expert there, maybe even a buyer's agent, guide you through this decision, and you're willing to put forward an offer. Then there's templates that you can use to put in offers depending on what state. There's the data you need to look at. Then there's putting in the offer, negotiating with the real estate agent. But let's just say you put in an offer. In New South Wales, it's either via a 66W or with a cooling off period or at an auction. But let's just say you are successful. What then happens after that? You sign a contract, and then what happens after that?
So after that, we'll be lodging to the bank for formal approval. So it seems a bit backward, but the bank will only value a property upon a purchase once you've signed on the contract, so they know what you've paid for. So once we have the exchange contract, we could then take the process of ordering a valuation report. We'll also be chatting to you again to discuss, like, I suppose, final loan amounts and maybe loan structure. Probably shouldn't have changed too much from your pre-approval, but perhaps if you're fortunate enough, you haven't actually gone to absolute max of the pre-approval, and we can lower that loan amount, and you could adjust a few of the figures to accurately affect what you've actually paid for and what you're potentially going to be left with post-settlement.
And at that point as well, your solicitor or lawyer or conveyancer has reviewed the contract, they've reviewed the conditions in it, they've made sure that there's nothing detrimental to you as a buyer in it. Everyone is happy. So you're happy, your buyer's agent or you are happy, your mortgage broker's happy, the price has been accepted, the contract is signed, and now the bank is giving you the formal approval. Then what happens?
Yes, so the bank issues you the loan contracts. You go over them, obviously, with someone you trust, typically your mortgage broker. They'll answer any questions you might have. You sign the dotted line, and you've signed yourself up for a 30-year mortgage.
30 years of debt.
Yes, it's a 30-year term, but that you're signing and agreeing to, but typically you're not going to be there for 30 years. Documents go back to the bank. If there's any other conditions like reducing credit card limits at that point in time or insurance for the property, the bank will gather all of that information, sign off on it, and then it's just a matter of actually getting ready for settlement.
Pre-settlement inspection, typically some agents might mandate you do it the day before, but you could do it a couple of weeks before, you could even do it the day before. But what you want to go is inspect the property to make sure it's in the same conditions as when you've inspected it. So you want to check the taps, lights, air conditioning, dishwasher, pretty much everything that you possibly could, right? And it's probably good that you have a bit of a checklist to go over. If there is any issues, you've got a bit of time to negotiate whether to get it fixed or make adjustments.
Yeah, because it's supposed to be in the same condition of which it was when you exchanged.
Yeah. So don't expect a brand new home, but the same conditions as you seen it when you inspected it.
Making sure all parties are aligned, making sure that your solicitor's ready, the bank's ready, the vendor's solicitor and their bank is ready, and they all meet up, typically on an electronic platform called PEXA. You make sure the funds are in the right account leading into settlement, which you've nominated on the documents that you've signed. Yep. And settlement comes and bam.
We've done the pre-settlement inspection, we've signed all the contracts, we've returned to the bank, all parties are aligned, and bang, settlement happens. Great, awesome day. You get your keys, broker checks and bank, make sure everything is aligned as it should be. So what happens after that?
Well, you now have a debt that you need to repay. Hopefully you've set up your direct debit repayments as part of the documents that you've signed, so that will be automatically there ready. You need to make sure that you've got someone still on your side at that point in time. You want someone to be there to check in, that make sure that everything has been set up as it should be, that the offset account that you've opened is actually linked and hasn't just been left as a transaction account where it's serving you no benefit at all. You need to make sure that funds are in the account before the first repayment. You want someone to check that the first repayments come out correctly. And then you want someone to be there and consistently check on regular intervals to make sure that that product that you signed up for 30 years is still in your best interests moving forward every 6, 12, 18, 2 years.
And how important is that 6-month review, like that 6-month checkpoint?
For some clients, it's set and forget, right? They trust us so much. So having that sort of touch point every 6 months to go, is my rate still competitive in line? If it's not the sharpest, we do a bit of a comparison analysis to go, well, what's the cost of actually moving? It might not be worthwhile, right? So it's I suppose, you're partnered for life in a way that you've got this ongoing service. I'm very proud of what we can offer to our clients and the level of trust that they give us.
Thank you, Michael. Thank you, John. That was incredibly insightful, and I appreciate you guys going pretty granular with this. Thank you very much for your efforts, and I appreciate you guys being pretty insightful and giving us your time. Cheers, boys.
Thanks, Peter.
Thanks, Peter.
So that's it. That's another edition from our Black and White Finance video series. Start the conversation early, get that advice early, and hopefully we hear from you soon.